Thank you so much. Thank you for joining us for this conference on M&A and the changing landscape of consumer financial services and accounts receivable management. So the reason that we're having this is I occasionally get asked questions by clients about mergers and acquisitions and M&A deals, and usually the questions are about the bare essentials of what it means and how it could potentially benefit their business in different circumstances. This includes everyone from the soon-to-be retiree to the mid-sized debt collection company looking to broaden their client base or expand into other regions, to creditors looking to acquire companies in other states for purposes of licensing or increasing services, and many more. So based on these questions that I receive, I thought it'd be a decent idea to hold this webinar, bringing together the experience of two highly regarded professionals to discuss the fundamentals of M&A. So I want to talk a little bit about about how we're going to go about this. I guess the analog I can think of is, rather than it being similar to a band playing a pop song that they've rehearsed and recorded a million times, we're going to be doing it more like a jam band. There is no PowerPoint presentation. Alan and Brian have no idea what questions are going to be asked. And it's something where I think it leads to being unconstrained. It leads to an ability to have a dialogue and conversation that's based and built on fundamental knowledge, as opposed to something that's robotic and planned. And it's something new. It's something we're trying. If there's any chaos whatsoever as far as the questions, blame the moderator. That's me, because I'm the one that's promoting the question. So if Brian and Alan look at me at any point during the webinar like I have three heads, I'll realize that I should move on with a different question. So when I talked before about the best in the business, and this may age me, but when I was a kid playing Nintendo, the first game that I had was Punch-Out. And in Punch-Out, you would start with Glass Joe. You would start out going against Glass Joe, who was very easy to put down. But as you kept progressing through the ranks, you would end up having to face much more difficult competition. Well, with Brian and with Alan, we're looking at two of the best. And it's really my pleasure to be part of this with Brian and Alan. First, I want to introduce Alan Zeigler, who's my colleague and my partner here at Blank Rome. He's been an M&A lawyer for 35 years plus. He's been a Blank Rome partner for 30 years. He was, at some point, the firm-wide chair of the business department and the M&A and private equity group. And his focus is on both buy and sell M&A transactions in the middle market. Brian Greenberg is the CEO of Greenberg Advisors. He's completed over 130 successful engagements for clients over nearly 25 years. I know this from experience. I've known Brian for 10 years now. He's one of the most experienced and well-respected investment bankers in the accounts receivable management business, as well as revenue cycle management, healthcare IT, and business process outsourcing, BPO. Something that a lot of people don't know about Brian is he served 4 years in the United States Air Force prior to graduating from George Washington University, and he lives in the suburbs of Washington, D.C. with his wife, 2 teenagers, and an incredibly fluffy dog named Sally. And if we're all lucky, perhaps Brian will share a picture of Fluffy at some point during the presentation. So, I wanted to begin with, rather than opening statements, there's a lot of information that we can go over. So I wanted to just start with a question that is really based on the premise of the entire presentation, which is, the title of the presentation is M&A and the changing landscape of consumer financial services and accounts receivable management. So is the M&A landscape changing? And if so, how? Either one of you, please.
I defer to you, and I don't have a fluffy dog, I would say, too.
We'll trade off. Thank you, Scott. I appreciate the introduction, and I'm excited to do this, have this discussion today with both of you. So the M&A landscape is certainly changing. I mean, in the accounts receivable management industry, which is really the focus of most of my comments today, you've got an industry that has been undergoing consolidation now for many, many years. It continues to undergo consolidation. You have many new financial buyers entering the market. And as a result, you've got some pretty informed buyers in the market, both financial and strategic. And so those buyers are now, they're doing a lot of repeat deals, as you would expect, given the typical model for private equity investors. And you've got many fewer buyers that are just doing solo deals. Certainly there are still strategic buyers, many strategic buyers out there in the market. But it's much more rare for us to come across, very small companies acquiring other very small companies. It's more mid-sized and larger, which are in some way, shape, or form backed by institutional capital.
The only thing I would add to that is what we're seeing in this area is typical of what we're seeing in all of M&A right now. There's a lot of money, a lot of dry powder on the street, and I think the private equity folks are not as gun-shy to get into regulated industry as they were a few years ago because it's profitable, and for them it's just the bottom line. And a lot of what I'm going to stress today is due diligence and basically the private equity world and the financial world, there's SWAT teams that come in and scrub a company, so they feel pretty comfortable that in the end they're going to get what they bargained for.
I would actually, I totally agree with that. And one thing, now I've lost my train of thought. On the willingness of more financial buyers to invest in consumer finance businesses and consumer-facing businesses, we have absolutely seen that. I mean, there are groups that I've known for many years that in some cases they used to be invested in, say, the collection or ARM industry. They got out of it for 10 or 15 years. And in the past 2 or 3 or 4 years, many people have said to us, we've been waiting, and the timing looks right now.
Yep.
So they're coming back.
And I've noticed it from a layperson's perspective. There's been more talk about it ever since there's been changes even with the CFPB, now the BCFP, which I don't think I'll ever get used to, because they're no longer really using enforcement as a rulemaking mechanism. So I think there's a little bit more certainty in the market, and I think people are a little bit more bullish. To that point, how about advancements in Fintech, specifically consumer financial technologies, impacting the U.S. M&A market? A lot of companies now are looking, I think, at transformative technologies that companies may own to remain competitive. And how exactly is that working as far as the interplay and the changes with the technologies, with the changes in the M&A market, if any?
From my point of view, Fintech is so hot right now that the multiples are through the roof. They're multiples that I've not seen ever. I mean, there's a fair amount of financial and strategic buyers, especially public companies, that are buying Fintech, paying high multiples, but the private to public bump, if you will, is not making them gun shy. So they're moving forward on paying high multiples. So to me, that's the biggest thing I've seen. If you have a Fintech company right now, you're in pretty good stead.
And that's what I'm hearing. We don't see a lot of it in the ARM industry proper. There are a few companies that are technology oriented. I mean, there are certainly tech companies in the industry, but in terms of companies doing something truly different, I think those are further and fewer between.
Let me ask a basic question, and I've been asked this question before, and I'm curious how you would respond maybe on a high level. How do parties to a deal typically decide on whether to go with a merger or an acquisition? What are some of the variables?
When you say acquisition, I assume you mean buying the assets as opposed to buying the stock, which would be the case in a merger. If you're a buyer, as a general rule, you'd prefer to buy assets, so you're not picking up the historical liabilities of the seller. That's a basic fundamental. However, you might consider a stock deal if the target company is in states where you need licenses that you don't have, and it will take a much longer period of time to consummate that transaction. So to me, if you do want to buy stock, we could manage it. We do it all the time, and you just make sure. I'll go back to my theme from the beginning. Do your due diligence. Make sure that you understand what you're buying and the liabilities that you're assuming. And in a stock deal, you're assuming everything. And then, in addition, make sure you have in the merger agreement or the stock agreement a very strong indemnity. Perhaps there's a higher holdback as an escrow. Or another theme that I'm seeing, and then I'll ask Brian to weigh in, is rep and warranty insurance on M&A deals has proliferated to the point where at least half of the transactions, a third-party insurance company is going to help the buyer insure the risk.
Right. We've certainly seen a lot of rep and warranty insurance in recent deals, and I think it's a great mechanism to help people get over some of the risk that's inherent in any deal. There are a lot of benefits to having that as an option in a transaction discussion. But back to your comment about merger versus acquisition. I think there are some other things that can come into play that might be interesting to mention. First of all, in a merger discussion, you have to get the parties to agree to valuation of not just one firm, but now two, and how are they going to swap stock, or what are the mechanisms going to be that are going to, affect this merger? And that's difficult, right? Every owner of a business, large or small, has, let's just say, a tremendous amount of pride, and it can be a challenge to agree on valuation. The other thing that I think is interesting on that is there can be definitive reasons for wanting to do a merger. For instance, if one of the companies has maybe branding issues, and in the merger they're going to assume they're going to be absorbed into the other company, and their brand may sort of wither off into the ether, as you mentioned earlier. So I think there are a lot of different reasons for that. They're not easy to accomplish by any stretch, but no transaction really.
I'll just add, as you said, a pure merger is very difficult where it's a merger of equals. There always has to be one party that's going to be more dominant. It's very difficult to achieve parity in these transactions.
You brought up licensing, and this is something that's always interested me as far as deciding whether to do a merger or an acquisition. And when there's licensing, when you have a company A, let's say, looking to move into New York, and they need a license with the New York City Department of Consumer Affairs, and they come in and they find a company and they decide to whether merge or acquire the company, is it an automatic that licensure is going to be transferred? Because I would imagine that they still have to go through, especially if it's an acquisition, the rigmarole of reapplying and potentially going through all of the due diligence and getting that license. So, but if it was a merger, would that potentially help as far as getting the licensure, because it's not necessarily changing the name?
It helps when you buy the stock or you merge. It should be helpful because then you're dealing with just change of control, but the license stays in place. In some states, it's just notification of the change of control. In other states, it's you go through the process, but it's less rigorous than if you were to make an acquisition of the assets and the license normally doesn't get transferred. You have to start fresh,
right,
and that will take a substantially longer period of time.
Right. So a question of notification versus consent.
In many cases.
Yeah. Sometimes
there's consent, but even the consent when it's not a brand new license should yield a quicker result than, hey, we're coming into New York, we've never been here before, now we have to file a new license and,
Right.
So the next question may be one of these questions where you both look at me and blame the moderator because the question may not be well phrased, but we'll see. What's the biggest misconception through your experiences about an M&A transaction? When somebody comes to you, let's say a new potential client, and asks questions, what's some of the misconceptions that you think you may be able to demystify?
A couple things come to mind. The first would be timing required. I think people often, underestimate the amount of effort that's required to do a transaction and to get it over the finish line. Typically, if we're representing a seller, we tell them somewhere between 6 to 8 months from the time we begin to the time a deal closes and the wire hits. So now, we've completed them much faster than that. We've completed deals in 45 days. We've completed deals much longer than 8 months, but, that's the typical range. So that's the first thing that comes to mind.
And what comes to mind not only is what you said, and it's difficult, and people always underestimate, and I, as the attorney involved, and I'm the bystander trying to get it done, I never want to be in the position where I'm holding up a deal. So, for us, we'll just work through the night and do what we have to do. But people underestimate, I think, the post-closing aspect, how difficult it is to integrate cultures. It's just, and the best acquisitions are done where the buyers come in and they, I'll say, make nice, for lack of a better term. This isn't legalistic. This is humanistic. It's the human factor in an acquisition is critical to just make sure that we're all rowing in the same direction and that the target is, especially if you're going to rely on the senior management team to bring the results you want. So people underestimate that. Yeah,
I totally agree. I think too often, that 100-day plan post-closing gets overlooked, short shrifted in one way or another, and it's critical. It's just critical because, you might be able to get the deal to a closing, which is an accomplishment in and of itself, but you have to put the effort in all the functional areas of a business into what are we going to do in that first 100 days and then the next 100 days.
That's really interesting, is the integration of different cultural values for a company. And we've seen it over and over again that change in the short run does disrupt order and causes a bit of chaos. And it sometimes takes that long-term view in order for that cultural change to facilitate and to be able to come to fruition to be something greater. And how does that work? What role would you play as an M&A professional in helping out that cultural change? Is that something you plan for in advance with your clients, or is that something you continue to engage your clients with once the closing takes place?
Well, so for us, it depends on our client, right? So we do a lot of work with private equity firms and private equity-backed strategics, both on the buy and the sell side. But we also do a lot of work with mid-sized and smaller firms as well that just don't have that kind of experience, but yet they want to complete a transaction. And so, with our private equity firms, they're well aware. So, we're not heavily involved with those firms typically as it relates to those kinds of matters. But the mid-sized firms, absolutely. I mean, we're there suggesting ideas for them, things they might want to look into in due diligence, including, post-closing matters.
From the lawyer's point of view, we're even a tad less removed than the bankers. But what we encourage the clients to do is to make sure that the management team, not necessarily the owners, but like the star salesman whose ego needs to be stroked, stroke it before you wire transfer the money to the owner. Do the things that you need to do to make sure that folks are really energized about the new group. And closed a deal in the health IT space this past Friday, and the client we're in Philadelphia. The client was the target was in Kentucky, and talked to the client. I said, you got to go down there day one. Let them hear from you as the new chairman. Let them see your vision. That's what people want.
Yeah, and I think that the days are gone when, you could maybe meet an owner, if you're a buyer and you're trying to buy a company, and just meet the owner for dinner one night and the rest is all just done remotely. You do have to spend time, especially if you're integrating businesses and you really want to win people over and put people at ease, because people are, naturally nervous if they're not an owner in a business and they're not fully informed on a transaction. And then all of a sudden the word comes down that, hey, we're selling the company to so-and-so. You need those people. Yeah, they're important. So, it's about making them comfortable and providing the right information at the right time, and ideally doing that in a, as you said earlier, Alan, in a human way and a personal way that brings them on board to your team and starts to integrate the cultures.
And I'm really going to date myself, but 35 years ago when I started, we didn't have email, we didn't have Federal Express, and so the negotiations were always in person, and there was more of an effort not to rely on technology and emails. So you really do need to show up once you buy the company immediately to help the integration, especially in the middle market.
That's interesting. So in today's times, from the perspective of even a buyer or seller, how does one find the right partner? Is it going on to like a dating site? And no, I don't know anything about dating sites, but how does one find the right partner to do business with? Is it as simple as going on Craigslist? Or is there some way, is there something out there for a potential buyer or seller to really look into what else may be out there?
Well, I'm going to put a plug in for my buddy Brian here.
Thank you, Alan. I see where this is going.
This is really in the space of a really good investment banker. And what I see, and I hope you'll expand on this, is the best investment bankers really look at, well, what's the deal? Is it the seller is retiring, or the seller wants to stay on and have, one crack at the apple, but find the right partner? The key is to have a knowledgeable investment banker who focuses on the area, so that banker could say, hey, this is a list of 10 potential buyers that you would work well with.
Right. Thank you for queuing that up.
Okay.
Very nice. I couldn't disagree with you at all. No, look, we're a specialist bank. We believe in specialization. We think there are great advantages to having a multi-decade-long specialty. And what comes with that, as Alan mentioned, is knowledge of the participants in the industries in which you specialize. So, in our case, for instance, we know industry participants, and we've known them for many years. We've had breakfasts, lunches, dinners, and so forth with them over many years, either at their office or at conferences or wherever. And then on the other, and in doing that, we get to know them very well, as you might imagine. We get to know their interests, we get to know their business, their challenges, their short and long-term strategic plans. And so we take that back and digest that until the next time we see them. If an opportunity comes up, we want to be able to give them a call and reach out. Now, on the other hand, we're also plugged in with all the investors in those businesses, the potential investors. And so what that means is we're aware of whether they would like to acquire a minority stake or a majority stake. We're aware of the size and types of transactions they want to do. Do they want to do growth capital deals? Do they want to do just LBO deals? Mm-hmm. And so we've got certain ways that we track all of that information, of course, and we have tons of information that we've built up over the years on this. And it's all, it's highly proprietary, it's highly confidential, but that for us, being believers as we are in specialization, that's how you find the right partner, whether you're a buyer or a seller. Now, you could go out, you could find one, you could make a call or go to a conference and probably stir up a few leads, but it's, in our experience, it's not just about finding one or two leads because, it's the saying, you have to kiss a lot of frogs. So we believe that to be the case.
So in essence, it's not as simple as going onto a dating site.
Right, unless you consider us to be the dating site, and then, we can parse out, relationships as needed, I guess.
Well, the one thing that we do here at Blank Run, we work very well with the bankers and we defer a lot, but we also have our own relationship with private equity funds and acquirers. And if a client comes to us, and we always encourage them to get a third-party banker for a variety of reasons, all those that Brian articulated, as well as, the fact that it's best if you're not, as a seller, the lead negotiator, side the lawyer, but you need a financial person. But we're always happy to provide, our clients with entrees to potential transactions as well. We try to do that.
And I think your specialization works the same way. I mean, over the years, you've worked with certainly many, many bankers. You know who's good, who's maybe less than good, who you would, put your stamp of approval on. And so there's a lot of value in that, for sure.
And as far as value, one of the things that has come to my attention and something that has been brought up before, and I've even seen the question asked before, and I've never gotten really the solid answer. And perhaps you can give this here. I know I'm not trying to put pressure on either of you, but it is a question for the industry, or for many industries, is how do you evaluate the value of clients? You're acquiring a company. How do you know those clients that you're acquiring of that company are going to stick around? What type of guarantee do you have? And how does that play a role in the valuation of the company as far as what it's worth?
Would you like to?
Well, yeah, again, from our point of view, we're not focused as much as Brian would be on that, but we will do a very thorough legal due diligence analysis. We'll review the contracts. Are they short-term? Are they long-term? Are there unreasonable provisions in the contracts? Those are the kinds of things that, to me, speak to the quality of the relationship. After that, as a buyer, I always encourage, as part of the due diligence, if the seller will allow you, go and meet with the customers if you can. If you can't, because there's some sensitivity, you're a competitor, then what I've seen is a third-party survey company gets hired, not an investment banker, not a lawyer, not the buyer, but to do a survey to get analysis of, what the relationship is like. That's what I've seen.
Right. Yeah, those groups will do a market study for sure, and that's very helpful. So I think the value of any service business is the ability of the buyer to transfer those relationships over to their ownership and then benefit economically at the same or greater level than the seller did. Doing that is a whole lot easier than just saying it, right? So, and I think that gets into the diligence well in advance of a transaction. I think that speaks to a buyer knowing what they want and having a clear articulated vision on what they want and what they're comfortable with. But in the end, I mean, in the collection industry, most of the contracts are terminatable with a 30-day out on either side, and that's the risk that owners and managers live with every day. It's not easy, and it tends to sort of touch on some other key elements when it comes to valuation discussions and transaction discussions. Things like, is there a client concentration, right? So if one client represents a significant portion of the revenue, could that client really go away in 30 days? And the answer is yeah. In most cases, it could go away. But, if the service provider is performing well on, in any sort of scorecard metrics that most clients have on a monthly basis, and they can continue to serve the client going forward based on what the client's strategic plans are, then logic would dictate that they're likely to keep that client. But things do happen, for sure.
Before continuing our conversation on risks and liabilities, I just want to remind everybody that you can submit questions to questions@blankrome.com. We've already received a few, and soon we'll be presenting some of these questions to Brian and Alan. But as far as to go back to as you were just discussing risks and liabilities, how do you determine whether or not the information you're receiving, from the buyer's perspective, is adequate information? I mean, you mentioned before something that is stuck with me. You mentioned the term SWAT team. And when I think of a SWAT team, I'm probably not thinking of what it means in this area, but it seems to me that, when I go in and do an audit at a company, for whatever it may be, for a regulatory compliance perspective, the policies and procedures don't necessarily match up with the implementation of the policies and procedures. And it's fairly imperative, I would think, for a buyer to be able to know that what they're getting is what they think they're getting. How do you go about making certain that takes place?
So let me clarify the SWAT team analysis. The private equity world, remember, they're investing other people's money, so they're a fiduciary, and they have to make sure, to all the things you just mentioned, Scott, that it pans out. So they will bring in a benefits expert, a labor and employment expert. They'll bring in an insurance expert. In a highly regulated field like, accounts receivable management, they'll bring in a consulting firm or a compliance expert or, some professional that's all they do. There'll be reports prepared. There'll be very extensive analysis done. That's why, from the time, to Brian's point, it doesn't happen overnight. The worst deals are when you rush into something, right? You spend the appropriate amount of time. Now, you counter that with an anxious seller, and you have to draw a happy medium. And if a seller is really anxious and it's very competitively built, then you're going to spend a lot of money in a short term doing due diligence, but there's no substitute for it. You can't short shrift that.
So you just brought up another question for me then, is what steps are taken then to protect potentially privileged information between the seller and their counsel? If you have somebody coming in, a buyer coming in and looking at all this information to do their due diligence, how do you protect, or is there any mechanism to protect privileged information?
Well, again, there's a legal document, a non-disclosure and confidentiality agreement that's signed at the very beginning. And that applies in the body of that agreement. You make sure that it's drafted not only to apply to the potential buyer, but to the buyer's representatives. And those representatives, as part of the agreement, have to separately agree to be bound by the terms of the confidentiality agreement. Now, if there's competitors involved, you're taking a risk. There's no way around that. If you're a seller, so you show enough to keep the buyer's interest, you start negotiating the documents. As you get closer, hey, this is a real deal, then you show a little bit more. But from the buyer's point of view, you're bound by a confidentiality agreement. Now, it's worth the paper that it's written on, so that's where the banker comes in. Hey, these are reputable people. They know how to do acquisitions. They're not looking to steal your stuff. They're looking to make sure that the information matches up.
Right. And we've also worked on transactions where there have been stages of certain information that will be provided in the early stages based on this confidentiality agreement that we've signed. And then, you know what, if you're still interested in this and you become the buyer, or you progress to a point where you need and we want to provide you with even more detailed information about our clients or our contracts or our, any of the inner workings of our business, then we all agree now we're going to execute another confidentiality agreement down the road to govern those items.
Not only that, what we've seen is let's assume you're actually going to talk to the customer or you hire some surveying firm. As a seller, we dictate and agree in advance on the questions that could be asked. It's not like you could ask anything. We have a script, and you better stick to the script, and if you don't, the deal is off.
In a field like accounts receivable management, where there's potentially reputational issues, and we all know in the accounts receivable management world, the ones of us that are, when we're in it, is a company can get sued for not dotting an I or crossing a T, technical violations, allegations that turn out to be completely objectively frivolous due to the incentive of attorneys to bring lawsuits based on fee shifting provisions. How does one evaluate the reputational issues and actually look at it and quantify it?
Yeah. Quantifying it that's the challenge, I think. Identifying them, much easier. Maybe diligencing them through things like the market study that we mentioned earlier. If the buyer has certain concerns about reputational issues, they could structure a few questions for their market research firm to dig into those matters a little bit deeper. That can be good. I mean, you have to have good attorneys on the team. I mean, that's what they really do in that process. They're going to protect you in all the right ways.
Do you guys want to discuss any lessons that you may have learned from past deals? This is a wide open question. If there's anything that either of you want to discuss that might be interesting to the audience.
Go for it.
There's lessons if you're a seller, lessons if you're a buyer. If you're a buyer, the greatest lesson is, and I keep repeating this, is do your due diligence. So I was in a situation once where the transaction happened, and the next day went in, and the employees decided to leave. They weren't they weren't locked up, and they didn't have non-competes, so they didn't want to go for it. So it turned out there was lots of litigation afterwards, but that wasn't the result that anybody wanted. So the biggest lesson is make sure you know what you're getting if you're the buyer. As the seller, if you're thinking about selling your business, don't just start today and call Brian up, but think about it, get your house in order, start getting your financial statements to a position where they're auditable, make sure your corporate books and records. You only get one chance to make a good first impression, and a well-organized seller, the buyer will be wowed by that.
Yeah, and it really is obvious when you've got a well-organized seller, and unfortunately, it's too rare. And so Alan's point about calling a banker at some point early is so critical for that reason, because they can really help you see the business objectively, which you could never do as an owner of a business, and they can help you determine what areas you probably ought to work on, and that may also give some insight into timing and how long it might take to prep the company for a proper sale. In terms of lessons, I would add deal momentum. Mm-hmm. It's really critical. I mean, we've been in transactions of all types, all shapes, all sizes, some beautifully organized and prepared clients, some less so. And really, if you've got a seller, for instance, that has audited financials and is prepared and organized, and it just goes so much more smoothly. And one of the transactions we worked on recently was a divestiture for a private equity firm, and they buy and sell companies all day long, right? That's what they do. So they understand that, and they had owned this company for a number of years, and they had time to put into place the right team, the right pieces, all the right things in this business. And they were prepared, or almost prepared, when they called us and said, we want to talk to you about representing us in this transaction, with, all the data most of the data that they would want to populate in a data room. And we had other ideas as well, and we added to that. But that data room was done quickly. The company continued to perform well. The deal momentum kept just chugging along. The client kept hitting its forecasts and even exceeding them most times, and the deal got done fairly quickly as a result.
It's now almost 15, a quarter to 2, and I think we have a lot of audience questions, and I'd like to take one that I think you'll find interesting. If you're a mid-market company, and also these questions I'm going to keep whoever's asking them anonymous. If you're a mid-market company with a lot of resources, why not just expand on your own? What's the benefit of merging or acquiring another company, especially with the associated risks?
Yeah.
So I would say speed. The speed is probably the first thing that comes to mind. Clearly, there are risks, and that's what diligence is for. But, it all kind of comes back to having a long-term strategic plan. Where do we want to be, and how can we then get there? And then backing into what the steps are to achieve that.
It's an age-old question. Do you grow organically? Do you grow through acquisitions? And I think the best companies that I've seen over the years do both. They do both. It's very difficult to, for example, enter a new market with one client or one salesperson. But if you could enter the market with some mass, cost a little bit more up front, but the tax laws and the financial laws allow you to, to do it in a way that would be helpful.
And also, as you previously discussed, technology could play an issue. It can take a lot of time to develop certain technologies in-house. And by going forward with this type of transaction, you can purchase the technology because it already exists that another company may have.
Well, I want to go back to, it was the first question you mentioned about trends. We're seeing in almost every deal now a transition services agreement because the technologies that the buyer and the seller have don't always match up on day one, and it takes the better part of 3-6 months to integrate that. So to your point about technologies, it's not always that easy to transfer it.
So thank you. We have another question. What other professionals may be involved in an M&A transaction?
Sure. So in most transactions, you have 3 or 4 professionals involved. There's people like myself. There are people like Alan, which specifically are transaction attorneys, not just general counsel or business counsel, but people who specialize in understanding what items matter when it comes to completing an M&A transaction. There are also accountants, of course, involved. I'd say those are the 3 primary groups that come to mind. I mean, if you're a private equity firm, you'll often hire other advisors to assess things like risk and perhaps real estate or environmental issues and things like that. But I would say those are sort of a more detailed layer in the process.
Everything I agree with on the accountant side, that you're seeing 2 aspects of the accountants, the regular financial accountants and the impact that'll have on your financials, but you're also seeing the tax side of the house. It's always a good idea to have tax lawyers and tax accountants talk to each other. Make sure that everybody agrees on the tax treatment of the transaction. So that's critical. The other professional you might see stemming out of the accounting side is you're seeing almost every private equity fund today doing what's known as a quality of earnings report, a Q of E. One of the trends that I didn't mention that I have seen more, I'd be curious, Brian, if you're seeing this, is that sellers are doing a preemptive quality of earnings and presenting it as part of their package on the sale. And if it's done by a reputable group, that prep could save a lot of time and maybe even avoid the buyer doing their own Q of E, especially if it's from one of the quality shops around.
Yeah, I agree. We certainly see that. It's not, we don't see it that frequently because there's a significant cost to the seller to do that.
Mm-hmm.
And it's a cost that the buyers will most often cover if they're not presented with that kind of a study. But I agree. I mean, we've just within the past few weeks, I had a conversation with a seller who's considering that right now. It's a great strategy. It can speed things along. It can give you more certainty around what a transaction might look like, and there are a lot of benefits.
The other thing that it does is sellers today think they're in the catbird seat. You know, I want a high multiple. You do a quality of earnings report, you may be in a position where you're enlightening the seller to say, hey, your expectations may not be fit with the reality. Maybe you need to spend another 6 months to a year building this part of the business. Or so.
And just curious, yeah, I totally agree with that. Any sense of the QVs that you're seeing in terms of the cost to a seller?
Somewhere between, at the very low end, $35,000 to, $100,000.
I agree with that. It's it's significant depending on who we're talking about. It certainly needs to be considered, but it's an interesting development in these past few years.
We only have a little bit of time left, but this is a really good question that came in. If approached by a potential buyer, how does the target company determine the buyer's actual level of interest? Any thoughts on that?
Mm-hmm.
Go right ahead.
Very difficult question, because if they're a competitor and you start showing information, that may be to your disadvantage. So the first thing is get that non-disclosure agreement signed. Once it's signed, start to try to get a sense of how much money on external advisors that they're spending. Did they hire the accounting firm to do the quality of earnings report? Did they hire benefits consultants? Did they start spending money on legal counsel? Usually when folks are spending not an insignificant sum, we just talked about what a Q of E costs. Lawyers, have a cost. Accountants have a cost. Consultants have a cost. So that's pretty good gauge as to whether the buyer is interested. You could also look at the buyer's history. You say to the buyer, hey, what other companies have you acquired? And you call the former owners. That's a good way to diligence the buyer.
Yeah, agreed. I would look at that buyer's deal experience. Do they have any? I would look at their funding, as Alan mentioned, confirming to the extent you're not sure that they do have funding in place. I liked Alan's other ideas. And lastly, I would say I would just look at the logic of a potential transaction. Does it make sense for them to want to buy my company?
Great point.
Or could they just be fishing for competitive information, which, as much as I hate to say, people do. It's a horrible way to do business, but people do it. And so, we're sensitive to those kinds of things, whether we're on the buy side or the sell side. And we put people in check all the time as it relates to those sorts of matters. We were recently involved in a transaction where a buyer did approach our client,
mm-hmm.
and they were local, and it's competitive in that particular local market, as it is in most local markets in the industry. And there was a lot of concern about whether it was true interest or just competitive poking around. And I think we're getting to the point where we think it's the latter. So there are a lot of questions to look into when somebody knocks on the door.
We have time for one more question, and I'm trying to choose which one. I like this one. This is from the seller's perspective. If you're looking to sell, specifically in the arm industry, where do you find comparable data to quantify the market value of your company? I think that's a great question.
That is a great question. So interesting thing about the ARM industry, it's very private.
Yeah.
And so data is somewhat limited. You can look on the various sites like Capital IQ or the Bloomberg and these various things that a lot of people in the industry will use for information, or PitchBook and things like that. But in our experience, that only captures some of the largest deals out there, and it only captures some of the public deals out there. And most of the collection industry, for instance, or the ARM industry globally, is made up of, small to mid-sized firms, firms with under 25 million. In fact, firms with under 10 million in annual revenue is the predominance of the industry. So, who's publishing data on those guys? Nobody. What we've done for many years, I won't dwell on this, but what we've done is we've put together our own database of deal comps, and it goes back years and years and years. And we capture probably 100 to 150 different data points across each deal where we can. And we have that data because we've had the relationships, we've had the, right? Again, this is all highly confidential information. Nobody ever sees this, but we do give it to the industry in the way of a few M&A updates that we do a few times a year. We put, thank you. We do this a few times a year. And so we aggregate the data. We determine what we think are the most relevant points and the most interesting points to folks out there. And so that's how we do it. And then, of course, when we have a client that's engaged us to do valuation work, we rely on that data. When we have a potential client that wants to understand the possible valuation or terms that they might see in a market, in the market, we again aggregate that data and provide that as support for our conversation.
The only thing I would add, because this is truly in your realm, but I know from all my years of doing M&A that the only deals happen when you have a willing buyer and a willing seller. So you hire Brian, you do a process, you dip your toe in the water, you maybe send it out, your teaser or executive summary, you send it out to half a dozen potential buyers or a dozen potential buyers, and you'll see what kind of interest and what kind, and try to solicit an indication of interest or a range of value subject to further due diligence. That's the marketplace. Willing buyer, willing seller. The only way to figure it out is to take the plunge.
Yeah, and I would actually, do we have another minute, Scott?
Yeah, sure.
I would actually even, from the buy side, it's just as critical, right? I mean, it's the flip side of the coin. It's, so buyers out there don't necessarily know what the right valuation metrics are. So we do a fair bit of buy side work. And so, and that's even more challenging in many ways, because you have to figure out from among the potential sellers who are the ones who are willing to engage in a dialogue with you. And among those, which ones turn out to be the most interested, and then from among those, which ones turn out to be the most realistic about valuation and deal structure. And so it definitely cuts both ways, and there's, it's difficult to find that data. So if you can find it, you've got something valuable there.
So I think in conclusion, I'd like to continue this conversation, talk more about SWAT teams, Brian's dog named Sally, and perhaps even convincing Brian to show everybody his entire database.
Yeah.
Which, but I don't think we're going to get there. So I just really want to thank Brian and Alan for participating in this. It was
pleasure,
extremely educational, and thank you for answering my questions. Hopefully they were questions to your liking, because once again we did this in a manner where we were hoping to have a really unconstrained and cohesive conversation between two industry experts, and I think we accomplished that. So I just want to say thanks.
Thank you. Pleasure.
Appreciate it.
Thank you all for participating.